Hi, and welcome to our Share Plans Uncovered series, which aims to answer your frequently asked questions about employee incentivisation schemes. I'm Simon Adams, I'm a partner in RSM's Share Plans and Reward team, and I'm joined today by co-partners Martin Cooper and Fiona Bell. In other sessions, we focused on the plus sides for employees and shareholders. So in today's session, we're asking, what are the benefits of a share plan for a company? Fiona, starting with you, what does a company need to be thinking about when they're implementing a share plan?
So a share plan can be a management tool. So what they need to think about as a company, as the board, is what are we trying to achieve here? What are our concerns? It might be staff recruitment, it might be trying to align the interests and objectives of the shareholders with the employees, you might be looking for growth. So whatever it is, you have to design a plan that motivates the employees to achieve whatever that objective is. So the most important thing, therefore, is for the board to sit back and consider what is important, what are we trying to achieve, and hopefully if you can design a plan in that direction, that will lead you to achieving your objectives and greater profitability.
Thanks, Fiona. And it sounds like within those deliberations, there are going to be some costs and complexities associated with a new share plan. Martin, coming to you, how do you strike that balance to ensure that cost and complexity doesn't then outweigh the benefits?
I think it's an important thing to think about, and let's be realistic, a share plan probably is going to be more expensive and more complicated than just doing a simple cash bonus plan, maybe just completely discretionary. That's the reality of the position. However, I think keeping it simple is an important strategy when it comes to designing share plans. But what you're always trying to balance is that desire for simplicity against the need to have a structure that is sufficiently tailored to your business, to your people, and is going to create that alignment that we talk about between what shareholders in a company want to achieve and what we're asking the employees to do. So we're trying to strike that balance, and just as an overcomplicated plan can bring a lot of negative consequences, equally if we just use an off-the-shelf vanilla plan, then that can in itself fail to deliver what we're trying to get our share scheme to do.
And they're all really good points. Fiona, what are your views? In order to be a truly effective incentive and truly effective for an employer, do all plans need to be different and bespoke, or is the off-the-shelf standardised plan, does that still have a place in the industry?
There are a couple of problems, I think, with having just a standardised approach to a share plan. The first one I'm going to come to is actually for share valuations. So most plans do need to have the value of the shares determined, and that could be that you have to agree it with HMRC. If you don't take into account the actual company, the actual business of the company, the pressures affecting the company and the circumstances of the company, and just do some sort of multiple, some calculation, some formula, that often could be rejected by HMRC because you haven't actually used the real circumstances. It's just been a little bit too formulaic. So I think that's one of the first things to worry about if you're going to go for a standard approach. The second thing is, Martin's mentioned it, vanilla share plans. So I often have clients say, can I just have a vanilla share plan? Well, I'm as fond of a vanilla ice cream as anybody else. But the reality is your company a vanilla company? You're different from everybody else. You've got some special circumstances. So therefore, those need to be reflected. And if you do not reflect those particular points about your company, you're really not going to be able to make the best use of this management tool, this share plan. It's just not going to hit the mark and you won't achieve your objectives.
They're all really good points, Fiona. And for the record, I'm chocolate flavour ice cream. But I think what will really ring bells with people is when you talked about interacting with HMRC, which can be a really important part of tax advantage plans. Martin, coming to you, what's your view? Does increasing those touch points with HMRC, does that increase the overall level of scrutiny from the revenue? And is that a good or a bad thing?
So we're really lucky in the UK. We've got some of the most attractive share plans in the entire world. And those share plans have been put in place by successive governments for a particular reason. They want companies to incentivize their employees. They want the employees to be able to share in the value of their company's success. And they're happy to offer those tax advantages for doing so. And the vast majority of our interactions with HMRC when it comes to share plans are positive, encouraging, helpful. And so I absolutely don't think that companies need to worry that interacting with HMRC on tax advantage plans would increase scrutiny in a negative way.
Thanks, Martin. And keeping on that tangent of tax treatment and dealing with HMRC, we often talk about the benefits for employees, but is there something in it for an employer too, at the corporate angle, Fiona?
Yeah, so a share plan is a tool. It's a management tool to improve growth. And of course, government always wants there to be growth. So there are, in particular, 3 tax advantages that a company can have if they set up a share plan. The first one is that when shares are awarded to an individual, there is an opportunity for a corporation tax relief equivalent to the benefit the employee has received. So let's just put this in context. If, for example, you've got 100 employees all receiving £10,000 worth of benefit, that could be the equivalent of £1 million CT relief. That's pretty impressive and pretty helpful for a company. But there's more. As I said, there's 3 things. So the second one is that if you use one of the special tax advantage schemes, there's no PAYE, no national insurance, nothing like that. That has to be operated by the company, and therefore that is another advantage. The final one, and this is a particular special one, if for some reason you do not qualify for a tax advantaged plan, and so there is tax and national insurance to be paid, the national insurance contribution that is made by the employer can actually be transferred to the employee. It's not quite as awful as it sounds because the employee would get tax relief for that, but it does mean that the burden that is otherwise 13.8% of the gain made by the employee, that can be put from the company to the employee, so the employee bears the cost.
Thanks, Fiona. And from what we've said here, it sounds like some really quite tangible benefits for companies. So thanks very much for sharing those. Clearly some tangible benefits for businesses to consider. If you'd like to know more about creating successful share plans, visit our website to watch the rest of our Share Plans Uncovered series. Subscribe, like, all of the usual things, and contact us using the details below. We'd love to hear from you. Thanks.